Volume switched off.
Yeah.
Start the today's market talk. Uh, the basic theme is that everybody is clear that the Fed is done, though they will not say it in so many words. And just because of that, on Friday the US 10-year yield fell to around 4.66 from around 5, which was around 2 weeks back. And as Powell spoke on Wednesday, equity markets rallied because people became clear that now they are done with it. So it is maybe not higher for longer, maybe high for longer. And bond yields edged lower. And the best part was that the Fed said that they don't see any recession in the near term. So the sentiment changed. So the Fed chairman, Jerome Powell, rescued the markets around the world this week. Otherwise, everybody was in a bad state. And the other good part is that the Israel Hamas war seems to have already receded to the economic background. So it is not affecting the economies or any other issues or affecting the market. So, rest nobody cares now. But the effect will depend on how far the war and political ramifications will spread. So far, effect on oil prices has been modest, and right now the big question is as to up to what level the Israel is going to go to. The other point is that we may be starting our Santa Claus oblique Diwali rally. U.S. economy has been resilient after facing a 500 basis point hike in the last year and a half. But though October was bad, but November has started well after a weak October, and we might, be poised higher. India stands out among all the emerging markets these days because investors are careful with China, and our macros are good English-speaking population, stable democracy, and there is a good momentum in the manufacturing. Now, talking about certain few stocks which are in news, L&T orders in hand have jumped to an all-time high. Execution has been robust, and domestic capex cycle continues to grow. So they are the beneficiaries of strong execution, lower raw material prices, which are helping the margins, robust order inflows, and pick up in project execution in international projects. So actually, if you see their management commentary, they are getting more of international projects and less of national projects. Margins have declined due to continued execution of legacy projects. Year on year, there was a 0.4% decline. Quarterly order inflows of rupees 89,000 crores, of which two-thirds have come from Middle East only. So if you see the FY24 expected EPS is around 100 to 102. Right now it is at around 29 times, while SOTP FY25 valuation is what some brokerages are giving is around 3150, which is another 5-7% from here. Out of that, 2150 is from their infra business and 1,000 from their subsidiaries in IT, finance, real estate, etc. The one more reason why the revenues and the profits were and margins were low was also because the subsidiaries are like IT is performing weak as on date. NTPC is on a path to deliver better returns, and its higher capex plan should reassure BHEL investors also. So NTPC, what we are seeing is higher generation of power due to strong demand and improved plant utilization and availability. Lower share of imported coal has improved the profitability because Coal India is picking up. So all three, as I was saying, all are related: NTPC, Coal India, BHEL. Monetization of renewable assets would unlock some value for them, so that one should keep in horizon. Year on year, revenue improved around 2%, but profits were up 38% due to margin improvement of around 440 basis points. They added 1400 megawatt capacity. FY25 EPS is expected to be around 25-26. So at that EPS, it is still below 10 PE. It is aiming for renewable capacity of around 60 gigawatts by 2032, and dividend yield is 4%. So it is a safe play in this market, and it has corrected from around 250 to around 230 level. Now, talking about BHEL, BHEL is the large supplier of thermal power generation equipment, and NTPC is likely to award contracts of 11,200 megawatt next financial year. BHEL supplies boiler turbines and generators, and not only NTPC, several state power utilities are also planning to enhance their thermal power capacities. So, BHEL investors should remain assured. Now, rich product mix and soft input prices helped Maruti post strong Q2 numbers. Their product mix is good. Operating leverage is playing because of lower raw material prices. Costs are helping margins. They showed 11% Q on Q volume growth, and EBITDA margins improved by 370 basis point quarter and quarter. Revenue was up 15%, helped by multiple launches in SUV, and they launched a bigger SUV at a higher price range, I think about 20 lakhs in Victo. They are like right now leader in 10 to 20 lakh segment. So at FY25 expected EPS of around 50, it is at 20 times. So not it should be able to hold these levels definitely. Now the stock which is performing very well for the last two quarters I have seen is the Vesuvius India. It showed good revenues and profit growth, and basically it is a proxy to the Indian steel industry. It's the second largest player in refractory market. Revenue growth was around 17% year on year. Uh, Gross profit was up 34%. Margins improved by 595 basis points. EPS is up 67% year on year. The 2024 expected EPS is 120, so around 29-30 times it is there right now. It has nearly doubled this year. Uh, the the steel capacity in India is likely to be, I think, doubled in next 3-4 years or maximum by 2030. And the incremental capacity of 15 million tons is likely to be added by just three big players from March 24 onwards. Hence, this is a buy on dips, on all dips, this stock. The largest player is actually RHI Magnesia in this refractories, but the performance-wise, Vesuvius is the one which is performing better. The other point is that the Indian markets are ignoring muted volume growth and disruption across sectors. The recovery which we have seen in margins is basically due to decline in raw material prices. Uh, but across the board, revenues are not really growing, and this may be because of decline in rural consumption, as we saw in the results of Marico, Britannia, etc. Shrinking IT jobs, which will affect the after some time will start impacting even the real estate, and top line and volume growth is muted because of that disruption which we are seeing in terms of brand power, which we saw in results of HUL, etc. Distribution modes are not there because things are everybody is doing distribution, and market structure is becoming very competitive. Example is in two wheelers by electric vehicles, electric bikes, and even premium bikes, which had only one player, is now facing competition for more people. The bigger competition we are seeing in paint sector, where now multiple players are acting, and that large player Asian Paints is facing tough competition, so it will impact margins and profits. Hence, there would be a PED rating even if the profits go up. The other point is that the private sector capex is subdued, so the economy is growing because of government capex and investment of in real estate by uh, by the people. So these are the two things which are driving the economy. So that has to be kept in mind. Now let's see certain technical things. US 10-year yield, this is a daily chart. It had gone to around 5, and now it has come down. It went down below 4.57 in the on Friday. So it is now on the path downwards. And if it breaks the 50 EMA, then it is likely to head towards this level of 4, unless and until again there are some hawkish commentary from some Fed member or something like that. The Brent crude now again it's trending downwards, and it's gone back to around 85, 86 level. The whole rally, if you see, started because of this lower crude prices when they had reached around 70, 75 levels. And after that, once the crude prices started going up, the rally seems to be all over the world is halting. Gold, it had a breakout. It went to those 2000 odd levels, but generally it corrects from there. So let's see where it goes. And if the uncertainty is not there in terms of war and interest rates, then it is likely to correct. What I wanted to say out here only was that the way the bond yields and the gold and other issues are moving so quickly. When 7, 8, 10 days, things are changing so quickly. I don't understand the logic of having a multi-asset investing in multi-asset funds. So because the things are changing so quickly, how will the fund managers change their portfolios and all those issues? Now, US dollar index, this is a good thing. It has corrected and it's now reached around 105 level. On Friday, it had a big fall. So it went through the 20 and 50-day moving averages. And so if it goes down, then markets or emerging economies always do well. And the currency is also strengthened. DowJones, if you see a longer term chart, this is a trend line which is there from 2020 lows, and it reaches at around 33,000 level. And from 33,000 levels only, you see on the weekly chart, it bounced back. So in near future or by this year end, it is expected to hit this 35,000 odd levels. So it is looking strong right now. S&P 500 also, people were uh, looking at 4,200 level, but it has bounced back very nicely. This is a daily chart. So last week it bounced back from that 4,100 level, and now it is above the 20 and 50-day moving averages. So it is looking strong right now. India's 10-year yield again, it is at the similar 7.3 level. It is not going up or going down. So it's not right now impacting. Now let's see what RBI does or what is the RBI commentary. USD INR again, it's at the similar 8 point. It went up to around 8.33, 83.3 levels, but it has since corrected to around 83.12. So it will basically impact the companies which have got, if the currency depreciates, it basically impacts the companies which have loans in foreign currency. This is Nifty 50 weekly chart. So if you see here, last week it had a green candle, but week before it went and tested the last top. So if you see from 2021 and 23, Nifty had made a top around 18,800, 18,850 levels. So this was the trend line which was going up. Nifty tested that trend line and took support there. So till the time it remains above these levels, it's a bull market. If it goes below this, then that would be some cause of worry. But it bounced back very correctly. And in case on weekly charts, if it goes above the 20 EMA, then it should do well. So the levels to look at is 19,300 odd. So it should cross those levels. Now seeing the daily charts. So if you see here, this was that support at 18,800 which the Nifty took, and this is the last uh, this was the last lower levels from where the rally had restarted after a correction in August. That was 19230. So mercifully, yesterday the Nifty closed above 19230 after a gap ups. We had a lot of gap ups and it has closed. So it remains vulnerable. So it must cross these 20, 50-day moving averages up. Otherwise, it can head downwards now to close these gaps and may test that 19,000 levels again. So this remains a big vulnerability. Now let's see Nifty 50 30 minutes chart. What I wanted to show here was, you see, this was the week, right? Here uh, we had a gap down. It went down to around 19,000, and after that, there was no follow through. The market recovered, and again on Thursday and Friday, it had a gap up. Now, the point to note is, for basically the people who are dealing with the options and all that, that moment there is a gap up, after that nothing happens in 9 out of 10 times. So it's so easy to just sell 20 30 rupees higher call above the price and just book the profits at end of the day, because that's an easy trade. So this remains vulnerable because there is no follow through action here. So as we have seen that Nifty has moved from 18,800 to 19,250 to 30,250. So let's see what happens. But 19,400 to 450 should be the first level, as 50% retracement of the complete fall. And we have seen two upside gaps on Thursday and Friday, but nothing much has come out of it. As I said, gaps are always occur in the direction of main trend. So the main trend remains positive only. And the rally, as we have seen, started with a upside gap on Friday. So the point is, moving higher requires momentum, and uh, something has to give momentum to this. Though we must all remain a little bit cautious with keep 19,000 as a stop loss. Now let's see the Nifty option chain. It is very interesting, right? So if you see, the maximum call writing is at 19,300, and the maximum put writing is at 19,200. So that generally remains the range. But if you see the change, it's so interesting, right? We had a good move, 100 plus points move on Friday, but see the how much premium has changed of 19,200. Just 17 points, 19,250, 11 points. So on call sides, the premiums are not changing. After that, there is call writing at 19,400, 19,500. So all these levels will be resistances. And there is put writing also up to 19,000. So 19,000 should be a decent support. But the volumes are not very high right now, because people are not convinced on which side the things will go. The put call ratio, if you see, is there are 12 lakhs put this side and 15 lakhs, 16 lakhs this side. So it's around zero point 0.8. So it is that right now people more call writing is there. That means people are still not 100% sure about the direction, or not 100% positive on the markets. The problem is Reliance. It it has tried to go on Friday above the 20 EMA. So let's see if this 20 EMA of 2310 or holds, because it went below the 200 day moving average, and after that the next target should be 2350. Though the news is good, oil prices are coming down, and government has done something good for them for windfall taxes and all that. So it should work well for them. Nifty Bank, again, if you see, this is a weekly chart. It had a strong thing on this week, green candle. but it has corrected, and it has, on weekly chart, it has come to its 50 EMA, which is around 42,850 odd. So it took support there and has bounced back from there. So it should cross this 44,000 levels for a sustained momentum to come into this. Otherwise, it will remain vulnerable to selling, and this is the weakest part. This is a daily chart. So if you see, it went below the 200-day moving average, and then it went to around 42,000 and then bounced back from there. And last 3 days, we are seeing no movement throughout the day. So it closes and opens and closes at the same levels, despite having moment throughout the day. So it is not giving any kind of momentum or a strength right now. This is HDFC Bank. It has taken. It is still below the all averages, and it is looking weak. So it is giving some momentum in the last 2-3 days, but hopefully it should cross this 1500 level first, and then 1540, 1550 levels for some strength to appear. Otherwise, it remains weak and vulnerable to selling, and it is impacted because of basically FI selling. ICICI Bank is the bigger problem. The results and everything was good and all that, and it went below the 200-day EMA of 1925. So it went up to 900 levels, and after that, it has bounced back, and it is now above the 200 EMA of 925. So it should cross this 945, 950 level for some strength to appear, and then it can go higher. But it is very vulnerable to selling, and it made those double tops at around triple tops actually at around 1,000 odd levels. So from there it had corrected. So it remains pretty vulnerable to again same. It is impacted basically because of FI selling. PSU Bank Index I had brought out. If you see, this is a daily chart. It retraced, it went up to 50% retracement and then bounced back from there. And now it has reached the 78.6% retracement level. It is expected to go higher. So it should test in next 2-3 weeks its all-time high, which was there at around 5,400. Though the vulnerability will be there because SBI results and Bank of Baroda results were not that very good, though Canara Bank results were good. This is SBI one day. So if you see from the top, it has done 50% of the retracement and has roughly reached the 50 EMA. It went below the 200 EMA also. So it went there now, and here it remains vulnerable. It can go up, it can go down, though results are not that good that it should go up. So this is a basic issue which will impact the Bank Nifty, PSU Bank index. Canara Bank is the strongest chart. So if you see here, it has never basically gone generally not below the 50 EMA. If it has gone, the closing has been higher, and now it is heading higher because of good results and good asset quality. So it is heading higher, and in my view, it is still below one-time price to book. So it can easily go to 400 plus and then to 450 levels. So this is a stock to be kept in horizon. The public sector enterprises index is again bounced back from when it went below the 50 EMA, but it has bounced back very strongly, and it is again likely to head to those 6100, 6100 and above levels and test the all-time high. It is looking pretty strong, and the real strength is coming basically due to stocks like Coal India. Now, if you see Coal India, uh, once it had a breakout in September, after that it has, even in this correction, it never came below the 20 EMA, and it is one of the strongest uh, Nifty stock, and it is poised, and someday it is because it has now come closer to the moving averages. It is likely to go up again, shoot up higher in a short time frame. Nifty IT, it broke the upper trend line. This is a weekly chart, and but it took support at around 50 EMA. So it's okay. And some of the bigger stocks like Infosys and TCS seems to have bottomed out. So it can go higher from here, or may not dip that much, but it will remain within this range, the upper trend line and lower trend line range. Momentum index of BSE stocks. Now here, this one is doing well, and it uh, on weekly chart it went below the 20 EMA but bounced back, and it has not closed below the 20 EMA. So this one is looking good, and it had a weekly green candle. So it is expected to head higher. So watch out for these stocks which are part of BSE Momentum Index. Midcap Index, as I had brought out from here only, this red candle in September was a very weak candle, and it changed the trend. So it went down to its 100 EMA, tested that, and then bounced from there. Now it has crossed the 20 EMA. So mid-cap index is now expected to do better in case the constituents and the results are good. And the bigger issue is the SIP money which is coming into these stocks. Small cap index, similar chart to mid cap index, same. It tested the 100 EMA and bounced back from there, and now it is above the 20 EMA. So that gives strength to the market, and also the portfolios are good. So the basic mood remains good of the market participants. This is Nifty Reality Index. This has been the strongest index, and this last week it had a kind of a breakout from the 50 EMA where it was there, and in the last week it has gone across 20 EMA and is heading higher to all-time high. So this is the index which is looking strong with all its constituents. The major beneficiary has been DLF. This is a monthly chart. So if you see at in 2008, DLF was at around 1100, and it had a long roundish bottom formation, which is now seeming to be getting over. And it on a monthly basis, it took support at 20 EMA and now has bounced back. And it is expecting it can go to any levels from here. So it can go to 700, 800, or any levels, because this is a blue sky territory right now, because it is trading clearly above the this thing, and the real estate cycle is playing out right now. So, and real estate was the major exception last week, because rest of the things were not that strong. So here we are seeing good traction. Now the stocks we are going to discuss today. First is Tata Motors. The Tata Motors posted a strong numbers in two second quarters, led by reduction in losses in domestic EV business, expansion in EBITDA margins in both personal vehicles and commercial vehicles, and reduction in net debt of the company. The main cause is JLR. JLR's EBITDA margin remained strong at 14.9%, led by commodity tailwind, strong model mix, and operating leverage benefit. Order book at 168,000 units remains very strong. The margins of commercial vehicles and personal vehicles improved to 10.4 to 6.5 respectively. JLR is aiming for up to 2 billion pounds of free cash flow and less than 1 billion pounds of net debt by FY24, which will make the whole thing cash flow positive. The personal vehicle business of JLR and Indian personal vehicle business is on a strong growth trajectory, led by a strong order backlog. India's CV business is likely to improve Q on Q, led by market share gain in medium and heavy commercial vehicle segment. EV business is under control and losses are expected to come down in the coming 2 quarters. So the JLR has introduced new Range Rover, Range Rover Sports, and Defender vehicle. It's well on the track of deleveraging and expects to be positive on net cash by FY25, which is giving traction to this business. CV segment is focusing on market share gain and authorized service provider, that is roadside assistance factor, which is a key issue for commercial vehicles. as I brought out, the losses are under control. Now the EBITDA margin has come down to minus 5% now. So it is likely to become positive in 2-3 quarters. ICE PV's margins are at around 9.2% and targeting double digit margins. Their personal vehicles, Nexon, Safari, Harrier, are the most profitable products. And the key point is that there is a IPO of Tata Technologies which is in the pipeline. So there would be some cash will come to the company and it will further reduce their debt. And Tata Motors is a player also in the EV buses segment also, which is again big projects which they are getting from various state governments. Now let's see their quarterly revenues. The quarterly revenue improved 32% year on year and 2.8% Q on Q. But the key point here was the uh, the EBITDA margins, which year on year improved roughly 5% or 522 basis points, and the EBIT margins improved by roughly 632 basis points, that is roughly around 6%. So this is the one which is driving profitability, and as you can see from a loss-making business, it has now become profitable, and it is all because of this improvement in margins, which is on a upward uptrend. So if you see here, the consolidated revenues are growing and they are reaching higher, and the growth is around reaching around 30% year on year. EBITDA margins are inching up, and if you can see from here, they're bottomed out and moving up and reached around 13 odd percent. JLR revenues are again on an upward trajectory and showing a year on year growth of 30% plus. And EBITDA margins are also growing, reached around 14-15%. So, which is likely to continue. And this is what is impacting the profitability of the company. Now, one of the brokerages has done a SOTP valuation considering their CV business, personal vehicle business, JLR, and other Tata Tech and other businesses. So they have come to SOTP valuation with a target of around 780 in a year or so. So let's see if it can be achieved, but it's looking strong. But technically, if you see, it it took support at 50 EMA. It has not gone below the 50 EMA. It took support there and again bounced back. So, based on this results and positive news on this issue, and I think this stock will again further get a traction once the date of Tata Technologies IPO is clear. Next stock is Blue Star. Blue Star is India's leading heating, ventilation, air conditioning, commercial refrigeration company. Uh, they had a seasonable quarter for room ACs, but it maintained its market share at 13.5%, while room AC industry grew by 30%. The Blue Star's RAC business grew by 39%. Commercial refrigeration business witnessed good traction across segments: food, retail, hospitality, dairy, ice cream, processed food, food delivery, etc. The current market share of Blue Star in this category is at around 28%. Commercial ACs continue to witness strong traction from healthcare, industrial, and retail segment. It has leadership position in deep freezers, modular cold rooms, and storage water coolers. Net cash stood at 290 crore versus a debt of around 390 crore in second quarter FY23. This was basically helped because they did a QIP of 1000 odd crore, which they are likely to use for debt repayment and building manufacturing capabilities for Shri City RAC unit. Shri City is in Andhra Pradesh, and sub 300 liters freezers for various new product launches and R&D spends. Capex over FY 24-25 is pegged at around 650 crores. They are basically present in the high growth commercial refrigeration and electromechanical projects and packaged AC systems. Orders are coming in now from abroad also, Qatar, other Middle East countries, and they are developing products for the US markets also. So if you see the net sales changed by around 19.5%, so it is reaching that stage of 20% year on year growth. The profit margins are improving by around 24-25%. So it is maintaining that level. And PAT grew by around 66%. So, but this was a quarterly issue because this is generally second is a weak quarter because of the rains. But it is likely to continue. So year on year, they're expecting a PAT growth of around 38%. So if you see here, there is a EPS expected in FY24 is on 18. So if you see here, the year-on-year net sales growth is expected to be reaching around 20%. This is all expectations only, and margins are expected to improve. There is a PAT margins are expected to improve. So so the adjusted EPS for FY25 is around uh, 25 rupees. So at 25 rupees EPS, this is at around 1000 rupees right now. So it is at 40 times. So, but I think you can justify this valuation for the kind of growth, 30 odd percent profit growth it is giving, and a constant revenue visibility. ROC, ROE are good in 20% plus. So PE has corrected. It has traded at pretty high PE. So right now it is reaching at manageable levels. So uh, these are the key issues. These are the key ratios. So EPS of around 25 times in FY25. The PE would at the present price would reach around 35 to 36. ROC, ROE are 20% plus. RO return on invested capital 38%. EBITDA margins are improving and expected to improve. PAT margins and other issues. Debtor days are not going this thing up. Net debt to equity is now negatives because of that QIP, and they are becoming cash flow positive. Revenue trends, if you see, are up only. If you see around 19-20%, it had great time earlier, but now it is stabilizing as the size has grown. Year on year growth is expected to be around these levels. These are the expectations for gross margins, EBITDA margins, and PAT margin. So expected to improve only, and gross margins are expected to go 25%. This is a very competitive field, you would all know. So if you see the chart, uh, it had a kind of a strong movement on Friday only, and in this correction, it didn't correct much. It went to around 850 levels, but it bounced back very quickly from there, and now it is heading to 1000 odd. And it's a stock to be kept in horizon and bought on all dips. And if you see from years chart, it has hardly ever gone below the 50 EMA. So it's a strong business. Next business is Gail. It's a very complicated business. So it took me some time to understand this. Uh, they have 67.3% market share in gas transmission and 60% market share in gas marketing. The management has guided that gas transmission volume to average 120 SCMD. This is million metric standard cubic meter per day in FY24 and 132 SCMD in FY25. So roughly they are saying that 10% volume growth will be there in a year on the back of increase in domestic gas production. So uh, operating leverage will start working for them. Capacity utilization was 58% versus 53% in FY23. and by FY26 end, it is likely to touch 60%. And more the capacity utilization improves, their ROE will go up. They did a standalone PAT at 24.05 billion, that is roughly 2400 crores, which was a beat versus estimate. Their growth prospects are supported by a favorable tariff increase, healthy volume growth in gas transmission, and bright outlook for gas marketing. Policy enablers, gas demand CAGRs of 5 to 6%, and easier gas availability and lower gas costs are added catalysts for this stock. Uh, their their outlook is good for gas transmission and gas marketing segment, and new integrated tariff offers upside in gas transmission earnings, which is their main business. Risk is that tariffs are regulated, and but the point is that once transmission capacity utilization improves, right now it has reached 58% odd. So if it improves to 75%, so they will achieve that ROE of 12 to 13%. They will achieve, based on which the tariffs have been worked out. So tariffs have been worked out on the basis of an ROE of 12 to 13%. So the problem is it's a very regulated business and they cannot make exceptional profits. But they would be consistent dividend players. They will keep going up consistently and all that. And there is a valuation comfort also. So if you see, uh, net sales were down Q on Q and year on year also, but EBITDA improved 43% and nearly 97% year on year because of better margins. So the adjusted PAT improved 70% Q on Q and 56% year on year, and EPS is also much better. This is because the margins, as you see from here, have improved 342 basis points, and net margin has improved by 318 basis points just Q on Q. And this will happen because, firstly, if they are using better capacity utilization, those pipes are being used more, and uh, and the gas prices are down because rest everything gets regulated out there. Now, key ratios, if you see, the key thing to highlight here, I wanted to highlight was that they have to, from FY23, the stock had dipped because the ROE had dipped. So if it reaches around 12%, because that is what is priced in the regulated prices, they have to reach higher capacity to achieve that ROE. And then these margins and everything will improve. It is expected to be around 12.8, 13 odd in FY24. So if you see this EPS, it is at a PE of around 9 to 10, which is good, and it is at 1.1 times is book value. So it is relatively cheaper as compared to other stock. Why the stock is not going up is basically because of regulated environment. Now, one of the brokerages has done a SO2P valuation of this stock. So, considering all their investments and other issues and all the gas transmission, basically from here you can see what are their businesses: gas transmission, which is the major part of their business; LPG transmission; gas marketing non-domestic; petrochemicals; LPG and other hydrocarbon. So, keeping all these things in mind, this brokerage has come up with a one odd year target of around 145 to 150 is the target. So one can play this, and it's a very simple player with a dividend yield of around 4%. Now, if you see the chart, it is from last year where it made a bottom at around 80-85. It has made a higher high and higher low, and it is trending upwards within this range. So once it goes above the 20 EMA, it goes above slightly higher than the 20 EMA, it corrects and then comes back to test its moving averages, comes down and then again bounces back. So right now it is on that bounce back trajectory after the results and all have come, and it is very much impacted by news flows and other issues. But it's a decent stock which will give you as good as FD returns or something like that over a longer period of time. So I have finished. We'll take on questions now.